Getting out of drawdown. I know you don't want to stay in there. Most traders don't. The reality is, most traders are in drawdown. So how do we get out? I'm going to explain it from more of a holistic approach. I'm going to share with you a plan that we actually give to our funded traders on our in-house fund to avoid going deeper and deeper into drawdown. You need a plan. But first and foremost, you have to get your emotions in check. Most people when they're in drawdown have no confidence. Are you telling me you want to be the type of trader that you're only confident when you're in profit? Now I understand that is normal. It's a normal human response. When you're winning, you feel great. When you're in drawdown, all you're thinking about is trying to get out. You almost become desperate to get out of drawdown, and that's all you focus on. Then you attract the behavior that makes you go further into drawdown. That's the irony. So we have to switch our focus, bring some awareness to it and go, right, am I following my trading plan or am I just trying to get out of drawdown? That's a type of mindset. Am I following the actual statistical edge, or am I just waking up every day thinking about how do I get from -4 back to break even? I know that might seem logical, right? And part of that is true, but most traders become desperate and then they make bad decisions, wrong decisions. So I just want to share with you something and then I'll give you the plan. So stick around to the end of the episode. You'll understand exactly what you need to do. I'm currently in, so I'm going to keep this more a bit raw. I'm currently in Aussie Swiss, leaving this at break even. I'm going to let it do its thing. It's either going to be a break even or it's going to completely break structure and be the type of trade that I think it is. One thing you have to remember as well, so I've touched on a few things when it comes to losses, right? There are good losses and bad losses. There are also good wins and bad wins. Now you don't want to be, because you're probably wondering what's it got to do with drawdown. I don't want you to be the type of trader that takes a bullshit trade that gets you out of drawdown but is actually a bad win, and then you go, yep, that's the trade. Because I'm not saying this is a bad win, but let's say for example this is actually a really good trade, but let's say you took it and it wasn't meant to be in your plan. You bank your 8% on this trade and you're right, I was -2, now I'm plus 6%. Lovely drawing. Oh, perfect, I'm out of drawdown. Yeah, but you took the most garbage position and you think that's a good thing. It's very difficult to tell someone that just made money or made a lot of profit, do you know what? You done the wrong thing. You tell me, for those of you listening, how do you actually explain that to someone? Because it's not a normal conversation. It's like, what do you mean? It's because trading is one of those games that you can actually be rewarded for doing the wrong thing, and most people don't realize that. So just have that in mind. But in drawdown as a whole, that's where your character is built. That's where you are made. So you should see it as, right, I need to learn to be confident while I'm in drawdown. Where's that going to come from? That's going to come from self-esteem, your character, how you see yourself, right? You can't just be someone who, I'm only happy when I'm in profit. Well, whoop-de-doo, everybody is happy when they're in profit. How are you and what is your character like when you're not doing well, when you're not making money? How do you respond then? That's what I want to see. So before we move further into this episode, I want to touch on something very important that's going to be a key catalyst by you being consistently profitable long term, and it's psychology, but it's about having the right training. If you haven't been aware, for the last couple of years, we've had hundreds of traders go through our program. Rewired, as you can see here, we have Beyond Rewired and our core modules. Now, the core modules is essentially the A to Z to helping you learn how to think calmly under pressure. The end goal is to get you in a position where you're not nervous, you're not reckless, you're not revenge trading, and a whole bunch of other destructive things that are holding you back from getting to the next level. Now, these modules have been intentionally designed to essentially reshape the fabric of your mind and will be the key reason as to why you're not being profitable long term. You might have been someone who's had success here and there. This is going to help the consistency come in at such a high level. We can attribute over 90% of our traders that are on our in-house fund have gone through Rewired. So if you want to learn more about the Rewired program, all the links are in the description. So I want to share with you the plan in a second, but run you through just a bit of a recap of, I've just come off the back of a break-even streak, right? So I want to share with you why it's so important, because this links to drawdown. Because I have such a systematic approach in taking these trades, I'll start off with my first position for the week. Because I have such a systematic approach in taking these trades, I don't take trades in bullshit areas. What have I been sharing with you on the channel, guys? About how you can, even if I don't even know how you trade, the feedback I've got from the recent episodes is, now I get it, now I can see it. I'm starting to get that feedback. You guys are sending in the messages. I'm glad that's opened your eyes, because so many of you could already be profitable if you just got rid of the garbage trades, but you need to know how to identify where they are. So I'll explain it to you and then it'll make sense. So you see this Euro Aussie position. What do we have? We have a high. This is where most of the volume is going to step in. Now, this is on a personal account, so forget this one because it's a CPI trade. However, the concept is still here, and you'll see that in a second. Here's the gap between here. I've showed you this trade before. So this is the systematic approach that I'm waiting for. So that's my Euro Aussie position. But because of that, I can then look more objectively and go to my next position, which this happened to be a 1% loss, is what it is. It still actually ran for its full 90% mechanical management that's in Falcon Mechanics. There was a re-entry. I didn't get the re-entry. That's okay. Some people did. But what am I looking for? I'm looking for the same thing. I'm going to go to the lower time frame here, which I rarely do on here anyway. What have you got? Same thing. This is where most of the volume is going to kick in. Here's your gaps, takes out the high. There we go, right? Got taken out. Re-entry was roughly around here. Technically, you could have even put a limit order there. There was loads of ways to get back in. And there was a mistrade that I had on Kiwi dollar as well. Still a 7.4% week. So still a brilliant week. There were so many opportunities, because it's about when the market is hot, you need to learn how to milk it. When the market is super squeezing and corrective, you need to learn how to damage control, weather the storm, and stay out of the market. Traders fail to do this. That's why they're not profitable, because they're constantly looking for trades every day. Obsessed with, I need to trade the New York session, I need to trade the London session every day. No, you don't need to take trades every day. That's not how it works. However, so Kiwi CAD, same thing, looking for the same type of structure. We broke the high, we got our continuation, we played that. The management that I was talking about, so where it would have run us, I think I would have got it roughly at 4.7 based off of management there, but if I was going for the full mechanical management, I wasn't in this scenario, but it was available. That was an 8.3. So for anyone that took that, they banked the 8.3, which is beautiful. So that is a Kiwi CAD trade. Then you've got the euro dollar position. Now, because again, I'm in profit, right? Even though I've taken the -1 on Kiwi CAD, that's okay. I've got the 3.3. I'm in profit. Can I afford to take the risk on this momentum play? Now, this is more of your higher level of skill type trade. Probably a bit confusing for some of you because there's so much momentum. I cover this in all of the recaps in detail. This is not my first rodeo taking trades like this a lot. They are a bit more trickier to take, but if you can afford to take the risk, you can afford to take the risk. The problem is someone will be in drawdown where they're like this, loss, 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 right? So let's say they're on the sequence, maybe a break even. They might be here, EU shapes up, ready for the trade. Could have even got in here, right? Depending on what type of entry you wanted to take, right? Because you can get in with slightly wider stop and a little bit later on. It's not like it was only ready in 30 seconds and then it's there. That's the beauty of how we trade. What I'm saying is, you might go loss, break even. You're maybe 1% away from losing your funded account. Are you going to take a trade that's slightly higher in risk? No. If you would, because you're in drawdown. But if you would listen to my previous videos about not taking the bullshit trades and identifying where the volume is, where the value is, you would then be in a position to go, do you know what? I'm plus 2%, I can afford to take the risk. And guess what? You then get rewarded with a 5% trade because you can afford to take the risk, where you're constantly not getting rewarded because you don't put yourself in a position to get rewarded. That's what I want to sink in. So that's the euro dollar position. Pound Swiss was at the same time, so I didn't take this trade. I'm just showing you. This one actually dropped for a lot more. So I'm in Aussie Swiss. This is running at 1.6. This one is running at 6.25. This was actually a lot trickier to get in, so I'm more than comfortable to stay out of that position. Really and truly, I would have preferred to take it around here, but the entry is here. It's more of a lower time frame entry around there, but it's super high in risk. Technically, you could have a 10 pip stop above there, and you'd still be running, you know, roughly about 6-7%. It's a messy trade, but it's still there. Right, so I'm not too bothered about that. I don't care about the ones that run that I'm not involved in, because again, I will follow the same procedure. So I could look at that and go, why didn't I just take that one instead? It was both a Swiss pair, it was both shaping up. I would much rather take this for this reason. This is what helps with drawdown. I hope you get the message right now. No one's going to give you a magical thing to get you out of drawdown. No one can just do that. The bottom line is you need to keep your emotions in check, and you need a process for that. You need a risk model, which I'll share with you just in a second, but you need a systematic approach to identify the difference between where all the value is, but also what trades are lower in risk and what trades are higher in risk. And what that does is it helps you go yes, no, and keep it systematic. What most traders are doing, they just take any trade that fits the plan. They're like, well, it meets the plan, so I should take it. That's not the case, because you could be taking loads of trades that are poorly positioned and they're higher in risk, and then you're in deep drawdown, but you could have stayed out if you just asked better questions. So what I can look at is the confluences, right? I wanted these gaps to be filled. Look, gap filled, same thing I'm showing you, right? Taps it, comes back in, there we go, right? I can leave that break even, let it do its thing. Same thing, I'm not looking for anything different. It's the same systematic approach. Now there are of course layers to that, but I can't teach you that in one section. This takes, you know, time, it's methodical. There is a whole mechanics dedicated to just this, and this is one situation, but all this is a smaller degree of the bigger degree of the higher time frame that we're already moving. So the higher time frame narrative is already there, then it's just a lower time frame for confluence, and then it's, can I afford to take the risk? It's way more simple than you think. So I just wanted to share that with you. But the plan is important. So what I give to our traders is this. So let's say, for example, you're trading a funded account. Now it's going to be dependent on who you're with, so that's going to have different drawdowns. But what we do for us, so it's 5% fixed drawdown, right? So 5%. I encourage our traders to do 0.5, right? So it gives them more trades, gives them that buffer. And then what you do in terms of low risk and high risk, and this is where you need to be technically skilled enough to actually know. So let's say, for example, you're in plus 2% of profit, then that ignites the higher in risk, not high risk, but higher in risk trades, tick. And then when you're below that, it's lower in risk trades. And what that does is it gives you a protocol to be able to follow and go, right, what is my P&L looking like? How much am I up or how much am I down? What should I be risking? Then when you go below break even, so let's say you're into the core zero break even and you're below that, then you're going to go to 0.25%. So it's going to be 0.25. And then that is going to keep you in the game. So then what you're doing is that you're playing with risk. Now most traders play it the other way. As soon as they go in drawdown, they're obsessed with going, well, you know, I'm in drawdown. They lose their emotional composure. Then they start going, you know, plus 2% per trade. Then they lose that. They're like, oh, plus 3. They'll just literally do whatever they can to reset it and self-sabotage. So the simple plan I'm giving you, don't make it more complicated than this. I want you to stick to 0.5% per trade, not 1%. And then when you're in 2% profit, then you can afford to take higher in risk trades. Now, if you're someone who's asking me, Mark, I don't even know the difference. Well, again, that's system related. If you want a systematic system, links in the description, you want to learn how we trade, you know where we are. If you already have a system and you can identify that and you know, right, these trades are higher in risk, these trades are lower in risk, well, there you go. You got the answer. You don't need anything from me. Apart from that, you can literally crack on and just identify your trading plan, your setup, and go, these trades are higher in risk, these trades are lower in risk. Right, I am up 3%. Okay, well, that ticks box, you can now afford to take higher in risk trades. Why am I telling you this? I'm telling you this because a lot of traders spend a lot of time in drawdown, and most of the time why they're in drawdown is, number one, for emotional reasons. They can't even stick to their trading plan, and number two, they don't know how to carefully identify, is this trade higher in risk or lower in risk? So they make a lot of impulsive decisions, like it meets the plan, so let me just take it. And then that keeps them further into drawdown. I'm not even going to get into the rabbit hole of them taking the BS trades. That's in the prior videos. I've explained it. It's literally there for you. And what's crazy to me is that I'm giving you guys so much value and I don't even know how you trade. And I almost guarantee this will help you. So if this is helping you and I don't know how you trade, imagine if I did know how you traded. So we get a lot of questions about our in-house fund, and the reason why I put this model in front of them, because it increases the chances of them doing well. I know they're not just going to blow accounts. There's a reason why we have such good stats, because we're able to give them this protocol. They don't start over risking. They've got a controlled risk model. All they need to do is hit 7% and then they've upgraded their account. So let's say, for example, they start on 15, they then go from 15 to then 60. Then once they've made 10% on the 60, they then go to 6 figures. So 17% from when they started, if they started on a 15k account, which is not a massive account, you've only hit 17% and you're trading 6 figures. But you're doing it in a sustainable way. You're doing it in a way that you're not fluking it. Everything is intentional. So these protocols actually help you with a drawdown. You focusing all your time and energy on how do I get out is actually going to keep you further in.